Good afternoon, Facebook. Give us 1 second. We're going to let everybody log on.
Good afternoon, Facebook. How y'all doing?
Just making sure everything. If you can hear us, please press 1. If you can hear us, please press 1. If you can't, please press 2.
What's up, Facebook? We haven't seen y'all in a couple of weeks. Hopefully everybody's been doing good. Please remember, this is a interactive training session or just interactive session, so please make sure you have your questions ready. We will be answering questions, so make sure you get your comments or your questions ready to leave in the comment section. Please make sure that you share this video. And make sure you're inviting people to tune in, because ultimately, again, we want to help you guys out.
All right, give us 1 second. If you can hear us, please press 1 if you don't mind.
And if you can't, please press 2. Either way, we want to just know who can hear us and what the response is. Oh, and by the way, let me just say congratulations to all graduating seniors and parents. Congratulations. This is that time of the year where we would like to salute all the graduates and even the parents for the hard work, not only this year, but throughout the 12 years that you've been in public school or school period. So again, congratulations to all graduating seniors. Salute to all y'all.
And parents, y'all better get that credit right. Student Plus loans possibly coming. All right. So, and it's funny that we kind of laugh about it, but while we're on it, we might as well kind of touch on it. If you do have a graduating senior and they are getting ready to go to higher matriculation, actually going to attend college somewhere, you might be in the financial crunch where you might have to co-sign for some of the financial loans or financial aid that your child's going to need to possess in order to kind of get that college degree. So we kind of, it's kind of funny, but at the end of the day, it's not funny, because I just had a parent the other day just call my office, and she has a $35,000 Parent Plus loan for her daughter on her credit report, and she was concerned that just because she had a Parent Plus loan on her credit report that she could not qualify to purchase a house. Let me tell you this: if there's not a bigger myth that goes around in our communities, a lot of times it's believing that because we have student loans that we cannot purchase a house, or we have to actually pay off all of our student loans prior to purchasing some type of property or anything like that. That can be further from the truth. We're going to go over some of those things today that kind of talk about the qualifications and some of the tips you can utilize to be a first-time home buyer. But yeah, just keep that in mind. You might have to co-sign for your kids. And the last thing you want to do is let the financial mistakes that you've made in the past, possibly keeping your empire. I'm gonna say your empire, because your family should be looked at as an empire, from growing and actually being the best that it can be. So that's just my little soapbox theory for the day. But it's a good point, because we deal with that on an everyday basis.
It's real life, and ultimately that's what we're here to talk about, real life. So, ready? We'll get into this today.
All right. So today's session is going to be about the first-time home buyers. All right. What we're going to do is we're going to give out the credit tips or things that you can do, or the process that you need to be able to put yourself into play to be a first-time home buyer. Those of you know, I come from the mortgage industry back in, I ain't gonna say how long ago, but back in the days, I used to do mortgages full-time. I used to be a principal broker for my own mortgage company. And during that time, I used to get to see people, when I say financially undressed. Financially undressed means I got to see your pay stubs, your W-2s, your bank statements, your credit report. So I was able to see from a whole a bird's eye view of exactly how you're handling your finances, what components of your finances are you excelling in, and what things are you actually lagging or you're a lagger in those particular topics or subjects. So we're going to get into this. We're going to kind of keep today's live session a little bit brief. We're not going to go as long as we normally do. However, if you do have some questions, could you please put those questions in the comment section, and we'll be sure to kind of get those questions asked before we log off, okay? All right. So for those of y'all who want to buying a home, okay, Trev, when we have clients who purchase homes or come to us for purchasing a house, what are some of the questions or some of the things that you hear them asking coming in, or what do you think are some of the touch points we can just open up with to try to get an idea of, to let them know of what they should be looking for to become a homeowner?
Okay. Well, I'm going to start off with one of the most commonly asked questions, especially when we're doing the first-time homebuyer workshops. I always get the question, if I open up a line of credit when I'm about to purchase my house, is that a bad thing or a good thing?
Okay, good thing. Good. I'm not going to touch on that because it kind of opens up to the first segment of the first actual process of becoming a first-time home buyer. And the first thing we always normally suggest you do is take a look at your credit report.
You got to.
All right. And this is being done for multiple reasons.
And I just wanted to, before we jump across that hurdle, why is that so important? So that Facebook can understand from your perspective, why is that so important?
Well, you want to run your credit reports because you want to know where you stand from a financial standpoint. Keep in mind, the whole lifeline of your mortgage process is mainly going to be based off of the information you have on your credit report. Okay, don't get me wrong. They're going to look at your down payment. They're going to look at your income. They're also going to look at mainly your credit, because your credit determines, you can make $1 million a minute, but the interest rate that you pay on that mortgage is still based off of your credit score.
Exactly.
So let me back that up a minute. You can make $1 million a minute, but however, the credit interest rate on your mortgage, the mortgage interest rate has nothing to do with your income. So it's all going to be derived off of your particular credit score or your credit makeup or your credit history. So it's very important that you want to actually get that basis lined up first and kind of figure out where you're at. And keep in mind, of all the things that normally needs to be done to become a homeowner, normally the credit is the piece that takes the most time.
Absolutely. And that's what I really wanted to touch on, because a lot of times we get people coming in here and the first thing they want to say is, well, I already have the house, I already have know where I want to move, I just need to hurry up and get my credit right, and then we can make this happen. And a lot of times that is actually the most furthest thing from the truth, because more often than not, it is the credit, really not even the financials, it's the credit that ultimately takes the most time or prohibits the person from moving to that goal in the time that they actually like to do it.
Exactly. And if you don't know, if you don't know what's in your credit report, how can you actually maneuver yourself to position yourself in a better situation?
Absolutely.
If you don't even know what's out there. So it's going to be very important that you take a look at your credit report, and it's just simple things that you can do just as a regular layman, just to kind of make sure that your credit's in line. The first thing you can look at is the personal information. Right. Making sure that your name is correct. You know, they have the correct spellings of your name. They don't have different variations of your name. These aspects don't necessarily affect your credit score. They affect the security of your reports. And we say the security because if my name is Andre Coakley, but my credit report says Andre Williams, Andre Williams information could be possibly put onto my credit report. And a lot of times we think credit bureaus are like are like the church, or I'm not gonna say like the church. They're like the Bible. Like, they don't make mistakes. You understand? But the credit bureau is nothing but I ain't gonna say a big mistake, but they make majority of the mistakes they make keep me in business.
They make a lot of mistakes. In fact, statistics show 76% of all credit reports in the United States have inaccurate information. So that's 3 out of every 4 people. So more often than not, you do have something negative on your credit report. So if you're not staying abreast as to what's reporting, you could ultimately find yourself in a very precarious situation when it's time for you to actually need to make a move with your credit.
Exactly. And when it comes to credit, the other thing you can be looking at, not only your personal information, it's very big when you're getting ready to buy a house not to have a lot of inquiries on your credit report. Okay, getting ready to, that time span between you actually getting ready to purchase that house, those inquiries show your lender or your underwriter who's going to be reviewing. Now, keep in mind, when somebody is, or underwriter or a lender is getting ready to give you $200,000, $300,000 for a house, they're not dating you. They're marrying you. It's a marriage. It's a financial marriage. And because they're giving you these funds for a 30-year period, 15-year period, depending on the terms or the amortization period of the mortgage, they want to make sure that you can pay the payments, or you have the capacity to make those payments for the whole duration of those 15 years or 30 years. All right. Keep in mind, most relationships start great the first few months. Same thing with mortgages. Most people pay their mortgages on time for the first few years. All right. They'll break their neck. They'll do everything to make sure that payment is on time. But after you get comfortable and you feel that person's not going nowhere, or hey, I got them, they need me, we get a little bit comfortable, and sometimes we start missing payments. We're a little bit lax. We're not as attentive as we used to be from a relationship standpoint, and therefore we're not as prompt as we used to be from an actual payment standpoint. Absolutely. All right? So, they're looking at that from that standpoint. So inquiries show that you're out there, you're being thirsty. You're out there shopping for a lot of credit. For example, when I was a mortgage broker, I had a client who was pre-qualified for her property. We're getting ready to close. It was a Friday. We're getting ready to close the following Friday, a week from that particular day. Over the weekend, she went and she purchased some new furniture. Okay? She went and bought $8,000 worth of furniture and she put it on credit. What wound up happening is, right before she actually closed on her mortgage, the underwriter reran her credit report one more time right before closing to make sure she hasn't acquired any other new loans. She hasn't acquired any new debt. She hasn't gone default in anything. And when they ran her credit report, they see that she had an inquiry for this furniture company. Okay? Now keep in mind, the furniture bill didn't show up on her credit report, but however, just because the underwriter saw the inquiry, he asked her to provide information regarding this. And the information she provided was, hey, I got a loan for $8,000 for the furniture for the house that we're getting ready to buy. And believe it or not, that $8,000 threw off her debt ratio, which we're going to talk about a little bit later. And she couldn't qualify for that house just by buying $8,000 worth of furniture that had a monthly payment of $280. Okay? It wasn't even like it was an astronomical amount for this furniture. However, that little amount of payment pushed her over the edge from a debt ratio standpoint, which we're going to discuss in a little bit, all right? Okay. So, after you review your credit report, the second thing you want to do is improve your credit, all right? We don't want to just look at these errors and not really address them.
Well, I mean, improving your credit score simply can be the difference between, and just going back to what you just touched on briefly, it'd be the difference between you actually getting in the house and actually staying in the house. A lot of times, simply improving your credit scores 100 points can be the difference in saving you.
Like we have and actually, if you want our chart, we have a chart showing how much a difference of having a swing of 100 points in your credit score can have you winding up paying $110,000 more for a house. All right. So, for example, we have a client with a 800 credit score and a client with a 600 credit score. Well, let me even back up. A client with a 700 credit score and a client with a 600 credit score. They have a 100-point swing between their two credit scores. All right. Because of that, they can have a difference of an interest rate of roughly about 2 points. That 2 points over a period of 30 years will equate to $110,000. So, for example, at person A over here, he's buying a house, the same exact house as person B. The only difference between the two, they may have the same job. They look exactly the same. The only thing difference is this guy has a 700 credit score. This guy has a 600 credit score. They both are going to close on their house the same exact day. 30 years from that closing date, this guy with this 600 credit score have paid $110,000 more for his house than this guy with the 700 credit score.
House valued at the same amount.
House valued at the same amount. Everything's the same amount. Nothing is different. These are two twins exactly. One has a 600 credit score and the other guy has a 700 credit score. All right. Now keep in mind, that's over a 30-year period. So if we're talking about $110,000 over a 30-year period, how many cars would you have over a 30-year period? So now you add that to that $110,000. How many credit cards are you going to have over that 30-year period? Now you add that interest to that $110,000. How many times are you going to apply for insurance over those next 30 years? Now you add that compounded on top of that. before you know it, you can be easily just paying $200,000 more just to live the same exact quality of life as somebody who has a 600 credit score versus having a 700 credit score.
Simply put.
All right. So that's the importance of credit. Don't get me wrong. The guy with the 600 credit score will still possibly buy the house. They will still qualify him. But don't get me wrong. That lender doesn't mind or doesn't care about qualifying that guy. Why? Because they're going to make $110,000 more in interest on that guy. With that being said is banks and lenders don't necessarily want the client who has the best credit score. Why? Because the person who has the best credit score is going to get the best interest rate. The best interest rate means there's a less risk factoring for the lender. Therefore, the lender has to be able to charge a lesser interest rate. Okay? Versus someone who has banged up credit, a little bit rough, there's a higher risk factor. Because the risk factor is higher, the lender has to charge a higher interest rate. Why? Because they know that person with the banged up credit is probably not going to make as many payments on time as that person with the good credit. So they got to compensate for those times when you're not going to pay them on time. All right?
And understand, the lender's in the business of making money. So, and how do they make their money? On the interest. And also another thing I want to say, please understand, and I'm not here to bash no lender, but the lender is in the business of moving a unit. They are not in the business to make sure you have a comfortable quality of life or a good quality of life once you purchase this house. So understand, they will tell you, oh, well, your credit score is good. You're at a qualifying credit score. Let's go ahead and make this move. At the end of the day, they're trying to get the property off the books. You have to determine whether or not this is going to be an acceptable interest rate for yourself over the duration of the 30 years or however long your amortization period is.
Okay. For example, another example, we had another lady had a 600 credit score, was qualified for the property. She wasn't happy with the interest rate that she was given. She actually wound up coming to us. We wound up repairing her credit, helping her get her credit scores up a little bit higher, and she was able to buy the same exact house and have her interest rate cut almost up 1 whole point. So by her actually, taking the time, getting her affairs in order, taking that 3 or 4 month period, she wound up saving herself $70,000 in interest. Okay, so and keep in mind, not everybody falls into that category. Not everybody's going to need a few months to get in line. Some people might be able to get in line with just a phone call. Some people are going to get in line with a phone call, a dispute letter, a settlement. We're going to have to fight with your creditors. We're going to have to beg for. So what I'm trying to say is there's just so many different varieties and so many different layers, and nobody has the same exact process. I've seen a few 100,000 credit reports. I've never seen 2 identical reports. Okay, so there would be no actually for sure way to fix one problem. Everybody's problem is unique within itself. Okay? All right. So after you get your credit report, after you repair the negative things on your credit report, the next thing you want to do is you want to go to a lender to get pre-qualified for a loan. Okay? What does pre-qualification mean? Pre-qualification means you're going to go to the lender. Let's say Trevor's a lender. I'm going to go to Trevor. He's a lender. I'm going to say I want to buy a property. There's 3 major checkpoints Trevor's looking at just to pre-qual me. Just to pre-qual me, he's not really digging deep. He's just getting enough information to see does Andre pre-qualify, okay? So there's 2 different processes. There's a pre-qualification process, and then there's an underwriting process, all right? Pre-qualification, they're not really reviewing your documents. They're just kind of skimming over it, seeing if you actually fit the criteria to be able to purchase that particular property or to be able to get an idea of how much property you can afford based off of your credit, based off of your income, based off of your down payment. Okay.
Framework of it.
The framework. Okay. The skeleton of that pre-qual letter is 3 things. Your income. They don't know how much you make. Do you make enough to actually qualify for that property? And that's what we call your debt to income ratio. We're going to explain that a little bit in detail a little bit later. I'm not going to go that deep into that, but we are going to go on to debt to income ratio. But when you're getting pre-qualified for that particular property, so for that pre-qual, they might ask me for a pay stub. I might just give them a pay stub. They might just be Trevor's company. They're going to review over it, say, okay, well, Andre makes, for example, $50,000 a year. Okay, they got that. The next aspect they're going to look at is my down payment. All right, they're going to say, well, okay, well, he makes enough money to buy the property, but does he have enough money to actually invest into the property and put money down? Keep in mind, lenders want you to put money down on their property. All right. They're very skeptical with you buying things with no money down, because when you're buying something with no money down, you have nothing vested into it, okay? So that means the chances of you walking away from that property are a lot higher because you have no sweat equity. You have nothing vested into it. For example, I'm going to Trevor, example A, I'm buying a house. I want to buy a $300,000 house. Trevor gives me, he loans me the $300,000 as a mortgage company, okay? Here it is a year later. I don't want to actually pay Trevor anymore. I'm tired of paying the mortgage. I could walk away from this mortgage. And if I walk away from Trevor's mortgage, what's the only thing that I lose at that particular time? The only thing I lose is my credit history. My credit's going to be jammed up. I didn't put any down payment towards it. So I can walk away a lot easier. Just like when you're in a relationship and you didn't buy that person nothing, you didn't buy them all those gifts. But then you think about that relationship where you went ham and you went head over heels buying gifts, treating them, living the luxury life, and that person wants to break up with you. It's a little bit more difficult to break up with that person. Why? Because you're vested. Okay? So from a lending or mortgage standpoint, that lending or that mortgage company wants me to put down anywhere, depending on my credit, for an FHA program or first-time home buyers program, it's going to be roughly about 3.5% of the purchase price. Okay? So for example, if I was buying a $300,000 house from Trevor, 3.5% of that would be, if I'm correct, I believe it would be $10,500. Okay? So with those $10,500, I would need to put that down just to be able to actually wind up purchasing that property from that lender, because they want me to have some investment into it. All right. Depending on your credit status or how much credit you have, they're going to require you to possibly put down even 10%. If you don't meet certain income requirements, certain down payment requirements, or certain credit requirements. Okay. So don't get me wrong, I can have an 800 credit score, I can have $1 million in the bank, but if I don't have a job to pay back that mortgage on an every monthly basis, they're not going to give me those funds. Even though I got more than enough money to buy that property cash in the bank, they're still not going to qualify me. Why? Because they want to see the continuance of me being able to handle that mortgage.
Absolutely.
All right. Okay. All right. So just to recap, first thing you want to do, get a copy of your credit report. Number 2, improve your credit score. Number 3, you want to get pre-approved. Pre-approved means going to that lender, going to that mortgage broker, getting an idea of how much you qualify for. Okay, that's very important. I have a lot of times people come to me and they say, "Oh yeah, I want to buy a house." I say, "Oh, you want to buy a house? Okay, well, how much is the house?" "Oh, it's for $400,000." Well, I say, "Well, your payment on that, give or take, based on what we're looking at, is going to be about $2,000-$2,500. "Oh no, I don't want to pay that much money." Well, that person would have gone into that house buying process backwards, because they would have gone off a house that they visually like, but what they can't financially qualify for, or believe it or not, I have clients who can qualify for that house. They will qualify, but they don't want to pay that much in mortgage. So don't get me wrong. Just because you qualify for it doesn't mean that's how much you want to pay for a monthly expenditure. All right.
And like I said, when we first started today, more often than not, that's one of the biggest things, the biggest downfall when people come into our office. They've started backwards. They've already started the pre-approval process without even taking a look at the credit or understanding what needs to be improved. So again, the only thing I can say again is please understand, don't do things backwards.
Can y'all hear us, please? We just want to make sure y'all are hearing this correctly. Can you please press a 1? I'm just checking this up. If you can hear us, please press 1. Please press 1.
And please press 2 if you can't hear me, because I do know sometimes I tend to fade out and not talk loud enough. So please press 2 if I'm the problem.
And how you doing, Miss Hamilton? I do see your VA question. How you doing, Mr. Only, Kevin Only? I do see your question regarding FHA and conventional loans. We're going to get to that in a minute. Just let us get through this information. We'll gladly answer your questions. Appreciate it. All right. Thank you.
Number 4.
Number 4. All right. Number 4 is we kind of got into it already. You kind of opened up to it. You want to try to apply for, or you want to see if you qualify for FHA loan, first time home buyers, pretty much loan. All right. The reason why is because with that loan, it's the easiest loan to qualify for. Okay. Now again, just because it's the easiest loan to qualify for, depending on what your financial parameters are, depending on what your goals are, depending on what your expectations are with that particular property, FHA might not be just the best route, even though it's the easiest route to qualify. All right. There's multiple ways to skin the cat. All right. There's not one way that is the for sure way. Again, depending on your scope, depending on what you're trying to do, FHA might not be the option for you. But you want to try to look under FHA buyers, FHA program. And I'm gonna go over some of the pros and cons, some of the highlights. One of the highlights with the FHA program, you're gonna come down with a down payment of 3.5%, 3.5%, okay? Which in today's time, under regular financing or normal government financing, that's most likely going to be the least amount that you can purchase a property putting down, only 3.5%. Okay. One of the other things with the FHA program is it has very competitive interest rates. All right, these are government-backed rates because these government-backed insured rates. They are very competitive with the market. But keep in mind, you can go to 10 different lenders for an FHA program and get 10 different interest rates because those lenders have pricing. It's what we call a matrix. What that matrix is, depending on your credit score, depending on your income, depending on what type of property it is, all these banks have add-ons to your actual interest rate. So I can go to one bank, they might say, I'm buying a condo. This bank doesn't have an issue with me buying a condo. They're very condo friendly. However, I go to Bank B. Bank B says, yeah, we'll do the condo, but we're going to add 0.25% to your interest rate. Why? Because they're just not as condo friendly. They're a little bit skeptical. Their risk layering is a little bit more stringent for condos than Bank A. All right. However, Bank B could have a lower credit score criteria than Bank A. Bank B, even though they might not be condo friendly, they might accept credit scores down to 580. All right. They might accept credit scores down to 580, not 850. All right, 580. All right. When this bank over here, they might be condo friendly, but they require a 620 credit score. So what I'm trying to say, it's all over the place. You might be, you might hit one segment, but you might not hit another category. That way, that bank, even though they have the best rate, might not be the best option for you, or you might not even qualify for it because you don't hit some benchmark or some checkpoint in their particular underwriting process.
Just to kind of piggyback on that, going back to inquiries, that is exactly why, especially when you're talking about purchasing a house or a car, you will see that the lender will shop you around to multiple lenders to see whether or not they can find you the lowest interest rate. And ultimately, this is part of that whole factoring, if you will. So I didn't want to spend too much time. I just want to go back.
Gotcha. All right. So we got 3.5% down payment, low interest rate, gift funds. So let's say hypothetically that 3.5%. So I'm going to use the example I used earlier with the $300,000 house. I'm going to Trevor. I want him to finance a $300,000 house. He's the lender. He's the underwriter. For that $300,000, he's going to say, okay, Andre, I will actually approve the loan. However, you have to come up with 3.5%. As we stated before, that 3.5% is $10,500, give or take in that range if I'm correct. $10,500. So with that $10,500, if I don't have those funds per se myself in my bank account, Trevor's bank, if they allow me to give funds, or most banks allow me to give funds under the FHA program, I can come in and I can have my mom, my family member, actually say that they gave me the $10,500 to be able to purchase the property from Trevor. One of the reasons why the bank is very skeptical about you borrowing the down payment money, because at the end of the day, if I borrowed it, it still didn't come out of my pocket. So the chances of me walking away from it are still very high because it wasn't anything that's really breaking my back. It's breaking the lender's back, and it's breaking the person who I borrowed the $10,500 from. All right? So they will only let you give funds normally from a family member, somebody who's very close to you. And then you also have to document that that person's had those funds in their bank account for X amount of time, and showing it being transferred to your bank account. Depending on the lender, depending on the process, it can be a little bit more scrutinized than others. But keep in mind, just because you don't have the down payment money doesn't mean it can't be borrowed from a family member. Wait, hold on, let me back up. Gifted, not borrowed. It's a gift. So when your family member is saying that they're gifting it, they're saying that they're giving it to you, not borrowing it. They're not letting you borrow. If you go in telling the lender that that money is borrowed, now they're going to charge or assess a monthly payment to that money, and then that could be the reason why you don't qualify for that property. It could affect your debt ratio. Okay, so keep that in mind.
Twists and turns to this.
All right, good. The other thing with the FHA program, they will do credits. Now, okay, we're talking about FHA. Let me try to break this down. FHA is a government-backed program. Okay, it's government insured. FHA gives pretty much standard guidelines to lenders. So you have FHA, government guidelines, and you have all the different banks across the United States, okay? All these banks have access to do FHA loans, but they can put their own rules on top of FHA rules, okay? So let's say FHA rule says a bank can actually do a credit score down to 550. All right, but that bank might say, you know what, we don't want to touch anybody with a 550 credit score, so our internal credit score is a 600 or a 620. That if anybody comes through our program, even though FHA will allow that credit criteria to go down that low, we have an internal criteria which is higher or more stringent than the FHA criteria. Okay? All right? So that's very important to know. Just because, and a lot of times I hear people say, oh, well, FHA will do credit scores down to 500. The problem is, I haven't seen a bank that's going to give you decent financing with a credit score of 500. Most banks have a threshold of where they want you to be somewhere around that 580 range, okay? Most banks are looking for you to at least have a 580 credit score. Some banks, and majority of the banks, at least want a 620. Some banks want a 580, majority want a 620. It all depends on that bank, but I can tell you this. If you purchase that property with a 580 credit score versus that 620, your interest rate is going to be, I'm not going to say significantly different, but it's going to be, you're going to feel the difference in your monthly payment. It might not be astronomical. However, there is going to be a difference in payment because that difference of that 40-point swing in your credit score makes you a whole lot more riskier. And the higher the risk, the higher your interest rate. Okay? And another thing with FHA loans, they allow higher debt-to-income ratios, what we're going to explain in a minute. And they also are assumable, which means assumable. Let's say I have an FHA mortgage. I want to actually give my mortgage to Trevor. He could qualify to assume my mortgage. He doesn't have to qualify and actually go through a whole new qualification, get a brand new bank to buy out my particular mortgage. I can pass my mortgage on over to Trevor, and he will assume it for the same duration or the same terms that I originally agreed to. Very rarely do you see that happening in today's time. The only reason why you would see someone doing that, most likely if it's like a family member passing that mortgage through an FHA assumable mortgage to another family member. All right? That's the reason. That's the only way you normally, well, I'm not going to say that's the only way, but those are normally the terms that you see where somebody's passing on to another family member. The reason why is the average person or the average seller, if I'm getting ready to sell my property, I'm going to want profit. I'm not going to just want to give my property to Trevor and let him assume my mortgage. If I owe $100,000 on my property and my property is worth $300,000, I want to sell it to Trevor for $300,000, and I want to hold, and I want to rub, and I want to sleep, and I want to roll in my $200,000 every night. All right. However, if this was an assumable mortgage, all right, I would pass the property to Trevor. He would have to go through a qualification process with my lender to make sure he can qualify for it, and he would assume my mortgage based off of the same terms that I originally had. Okay? So again, that's mainly for family members. All right? Next topic, which we already kind of talked about, know your down payment options. All right? Down payment can be very, very, normally that's the part that kind of, that's the part that can kind of actually wind up keeping you from purchasing the property also. You can't get gift funds, you don't have family members put in place to be able to do it, and you don't have your down payment saved up in the bank account, you're just not in that position. However, some lenders, depending on their criteria, will let you tap out of a retirement account, out of a 401k account. All these accounts, even though they're not in a bank account, if you have monies in a 401k or some type of retirement or some type of other vehicle, they will allow you to use those funds for down payment funds. However, you got to be very careful. There's some caveats to that. Number one, if you're trying to pull money out of some type of retirement, you have to be careful to see if you're being penalized for it. All right. You could have some type of penalty fees assessed. You could have some type of transaction fees being assessed. So you want to actually do your due diligence on that part.
And normally in the state of Florida, it's up to 10%. So.
Right. And you have to be very, very even more careful on the tax liability side
Right.
of pulling out of your retirement. Okay, depending, I'm not going to get into that, but depending on what type of vehicle you have, from a retirement standpoint, pulling out those funds, you could be assessed a gains tax. All right, so you want to be very, very careful with that. However, know your down payment options for FHA program. You're going to need 3.5% plus closing costs. Okay, that's where a lot of people get jammed up to with buying a house. All right.
Mm-hmm.
So, for example, if I was buying Trevor's $300,000 house, my 3% is going to be that $10,500. Okay. That math is wrong, but we just gonna say $10,500. Okay. So with that money, that down payment, I have to be very, very careful with that tax liability. All right. When I say that, is because I've seen plenty of people buy houses, pulling out of their retirement, and then the following year they're wondering why they're not getting an income tax return, or they're wondering why they owe Uncle Sam. So you want to consult most likely some type of CPA, tax attorney, tax preparer, someone along those lines. Even your financial advisor might have some of the key information you need to know of knowing of how you assess that. All right. The next topic, you want to hire an experienced real estate agent. All right. The reason why you're getting to this point of hiring a real estate agent is because you need to get an idea of the price range of houses you're looking to purchase. I know that, when I've been out looking for investment properties, I might go look at a property and I might estimate in my head, oh, this house is selling for XYZ. However, when I talk to the real estate agent or I talk to the seller, it's a totally different price than what I speculated in my head. All right. So we got to know precisely what these properties are selling for. And one of the things I would tell you to do, if you're not really ready to buy a house, okay, if you're not really in purchase mode, be very, very careful with, getting involved with a realtor too early in the game. Why? Because a realtor's job is to sell you that property. And this is no disrespect to realtors. Their job is not to repair your credit. Their job is not to care about what your payment is. Their job is not to worry about, it is their job, but most likely their job is really to collect a check from them moving the unit, as Trevor said before.
It's their job. It's not their focal point. How about that?
I like that. It's their job, not their focal point. Their focal point is to move that unit. Part of their job is to make sure you qualify, make sure you're happy, make sure you get sound advice. But are they going to be breaking their neck to help you repair your credit? Most likely not. Are they going to be breaking your neck to make sure you go to work every day so you can qualify for this property? Most likely not. Are they going to be breaking your neck to help you, get your down payment together or get your credit together? All these things, they're not going to help you. They might help you with that surface things, but ultimately, it's up to you to manage your own finances to make sure you're securing your loan at the best possible rate possible. Okay? The best possible rate possible. Whenever you're buying a property, this is your biggest investment. And I've seen people, go look at the first house they've seen. The first house. Oh, this is the house I want. I love it. Don't get me wrong. There's nothing wrong with falling in love with something that you like. But with your biggest investment, you want to actually do as much scrutiny. You want to test the market. You want to see exactly how, how this property is going to affect you, not only from a shelter standpoint, but what it's going to do from an investment standpoint. All right? Because keep in mind, buying a house is not only shelter. If your equity is trending up, it's also an investment. All right? So depending on what neighborhood you buy in, can affect the long-term value of your property. So these are some of the aspects where that realtor is going to come into play. Hopefully a good realtor is going to tell you, hey, you know what? Well, the values in this neighborhood are only growing by 4%. Versus the value on this neighborhood, their values are going up by 13%. So you might look at it not only from a house standpoint, what you like, just the appearance standpoint. You might look at it from the investment standpoint, because keep in mind, buying this other property or keeping it for another 5 years can revenue you anywhere between another $25,000 to $50,000 more in equity when it's time for you to sell that property. And that $20,000 to $50,000 equity could be the stepping stone or the block for you to put down on your new property, which can allow you to even buy more house with a lesser payment.
Yeah, no one's, for the most part, no one's first house is their dream house. In fact, for the most part, most people will purchase their first house, and it's underwhelming, if you will. It's just really more so just to kind of get in the game. As the years go by and you build equity, now you have the tangible aspect to actually go and get that house that you really want. So, take your time, get the name of the game is to get in. And again, it may not be that ideal house, but ultimately the ideal house will come from the investment side of the purchase, as you're building the equity over time.
Right, and keep in mind, just because you buy a house doesn't mean that's where you're going to stay forever. All right, so there is some balance that needs to take place when you're talking about selecting the property. That balance also, when I say balance, I could be buying a property, but if it's going to give me long-term equity in it, I might not be really looking at it just from a living standpoint. I'm looking at it from an investment standpoint. All right. However, most people go by appeal. They go by what they like. Okay. They don't really look at the whole number side of it. Especially a lot of us have kind of gotten a little bit flustered or a little bit frustrated after the housing crisis. Most of us don't trust the value or the equity that's going to be in our house in the future long term. All right. So just be aware of that. Your house that you buy is a savings vehicle. You're also it's a savings. All right. So just keep that in mind because it can be something that can be very beneficial for you. All right. So next thing, budget for all home ownership costs. Okay. When I say budget for all home ownership costs, we are talking about when you're trying to buy a house, right? You find your dream house with this realtor. You think you like it. What's one of the first things you're gonna do when you buy that house? If you like it, you're gonna sign a contract. All right. So when you sign a contract, you have to put normally a deposit of good faith down. That deposit of good faith lets everybody involved know that number one, you're serious about buying this house because you actually put something tangible up. All right. And also when you're talking about budgeting, it's very important for you to understand because people feel comfortable when you got that $5,000 sitting in your bank account and you're making, before you buy the house. But now you're in contract. You took your $5,000 that you have in your bank account and now you placed it with this realtor, with this title company, with this seller. They're in possession of your $5,000. So you got to be able to maneuver and still live your life with not having your mind on this $5,000 that just left your bank account. Okay? What happens is a lot of times people only have enough funds to be able to purchase the property, and then they don't keep enough float for them to float themselves during that period of while they're in contract. Okay? Now there are going to be other incidentals that you have to pay for this property before you even close on it. Okay? The next thing you're going to have to actually get on that property is most likely an appraisal. All right? Depending on the scope of the property, appraisal can run you anywhere between $400 to $700. All right? And you don't own this property yet. And put it this way, that money is non-refundable. So when you purchase or when you're in the process of purchasing this property and you get an appraisal, that's $300 to $400 to $700, it's gone if you don't purchase that property. Then the other things you might also have to acquire or actually have to purchase to get in that property are inspections. You might have to get a roof inspection. You might have to get an electrical inspection. You might have to get a plumbing inspection. You might have to get a pest inspection. And all these inspections are based off of normally the age of the house, the condition of the house, the comments that the appraiser puts in the appraisal. So there's so many other aspects that actually wind up, you're putting these funds up to purchase this property. So it's going to be very important that you qualify because you're going to be spending your money on for something you didn't qualify for in the first place. Why? Because you just went through the motions. Okay? So don't put yourself in that situation. Make sure you put yourself in a position to be able to budget for home ownership. All right? It's not cheap. It's not cheap. All right? Next section. Know your debt ratio. Okay. So I've been talking about this earlier. Debt ratio is probably the biggest, especially down here. We're in Miami, Florida. property values are sky high, off the chart, and off the chain, if that makes any sense, all right? So normally what we see down here, most of the people who want to purchase a property, their debt ratio is what knocks them out of the ballpark. Now, your debt ratio is how much you qualify on a monthly basis, okay? The problem is when we think about debt ratios as regular laymen, we think about, okay, let's say, for example, I make $4,000 a month. When I go qualify with this bank, I go to this bank and I say, you know what, I can handle up to $4,000 worth of debt on a monthly basis. But the lender looks at that and they say, well, you know, Andre, you know, if you qualify for something, we're only going to take 50% of your income. And all your monthly expenditures, all your credit monthly expenditures can only come up to 50% of your income. So if I use the example of $4,000 a month, right, that's my income. My debt ratio at 50%, that means the new house payment, my car payment, and any credit card debt I have only could come up to $2,000. Why is it done like that? Because banks know that based off of looking at my credit score, they don't know if I go to the strip club every weekend. They don't know, ladies, if you go to Macy's every weekend. All those things aren't necessary. Your spending habits aren't necessarily displayed based off your credit report. So they know that you have all these other funds that are actually going out that they can't keep track of. So what they're going to say is, you know what, we don't want 50% of anybody's income, 50% of their income to be allocated towards the house payment, the mortgage payment, and any credit card debt. So for example, with the example, if I make $4,000 a month and I'm buying a $300,000 house, right? For an example, and let's say my monthly payment on that house is $2,000 and I have no other debt, I would qualify for that mortgage, okay? Why? Because I make $4,000 a month, all my monthly expenditures, that new house expenditure is only $2,000 a month, I don't have a car payment, and I don't have any credit card debt, all right? That's that 50% threshold, I will qualify. That's good. Example 2, I make $4,000 a month, we have this house payment of $2,000 a month, but I have a $300 car note. So now I have $4,000 worth of income, but $2,300 worth of expenditures. That $300 car payment would push my debt ratio above that 50% threshold. Therefore, it would not let me qualify for that mortgage. All right. Down here in Miami, or down here in Florida, a lot of times we see a lot of families who don't qualify because of debt ratio. All right. Why? Because they might have bought a car that they couldn't. Well, like I said, they can afford it. But the affordability factor when it came to purchasing a mortgage or getting into that mortgage, it was counterproductive. All right? So I want to be very careful with that. I've seen, and again, the same example that I used earlier with the young lady who bought the furniture before purchasing the house. And the underwriter reran her credit report 2 days before closing and saw that she purchased this furniture, and it disqualified her for purchasing that property. So she lost her money for her appraisal. She lost her money for all the inspections that was done. She had all her stuff packed up in a moving truck. She had canceled her lease in the apartment that she was in. It was a mess. It was a mess. So don't have yourself in that situation. We tell you these stories to lead by example. We don't tell it to kind of poke the finger at her. However, we're just letting you know how easy it is to make a simple mistake, to make all the hard work that you put together to purchase that property be your void. All right?
The only thing I want to say is just to our clients, that's exactly why we always tell you guys, hey, if you're trying to buy the house and the car, do the house first. For that reason, the car will more often than not be your mortgage company's biggest competitor. And so ultimately what you want to do is you want to alleviate that.
Glad you said that, because a lot of people come to us and say, I bought a car to build my credit. Please don't think that.
Too.
All right? Don't get me wrong. We don't ever want you to create debt to build your credit. That's counterproductive. All right?
And there is a difference between credit and debt.
You want to explain that to them?
Well, yeah, definitely. Credit is like a credit card. You get a credit card with a $5,000 limit. You haven't swiped that card. The card is open and active. You have an available credit of $5,000. there is no debt because you haven't used the car. However, with the furniture store loan, you get a $5,000 approval for furniture. You purchase that $5,000 furniture set. You now owe that company $5,000. That's no longer a line of credit. You've actually taken on $5,000 in debt. The example of the credit card is what we call revolving credit. The example of the furniture store loan is what we call installment line of credit. So understand that revolving line of credit is always going to be credit. That installment line of credit, more often than not, is going to be you taking on debt. Okay.
But keep in mind, some installment credit might be useful. Installment credit depends on the type of credit. When we're talking about the types of credit category, it's very good to have an installment line of credit. I just don't want you to go out and grab something that's going to have you in debt.
Right.
All right. So there's other little small installment loans that you can actually acquire to actually be able to accomplish that segment of different types of credit category. And it'll help you out, but we don't want you to be in debt trying to actually get some type of installment loan. So
and that's the name of the game,
right?
Having credit, not debt.
Right, exactly. All right.
All right.
So next topic, we're getting ready to finish up. Next one is check first-time home buyer programs and grants. All right. Even though we're very important, we're a credit repair company. We work very, 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 very closely with down payment assistance programs. Government programs, anybody who helps people with grants, anybody with the down payment assistance of purchasing a property. Keep in mind, whenever you're most likely getting any type of down payment assistance or you're getting any type of grant, there's possibly going to be not one underwriting processes, it's going to be two underwriting processes, okay? So don't get me wrong, you're going to have your lender, your mortgage company, they're going to be underwriting you because they're giving you the bulk of the loan that they're giving you, all right? So if this is an FHA loan, Trevor, they're going to do their scrutinizing for their 96.5% loan for me. However, my grant company or my down payment assistance company or my lender who's ever given me these additional funds, they're going to put me through a totally different underwriting process. Why am I telling you this? Because I have a lot of times where our clients have went and they've gotten approved from an underwriting process, but they haven't gotten fully approved from the down payment assistance process. And keep in mind, everything has to work hand in hand and everybody has to know what the other one's doing. So what happens is this lender wants to know that I'm getting down payment assistance funds. So what happens is I need to have my down payment assistance funds process pretty much completed and finalized so this lender can know all the terms of this down payment assistance program. All right? It's very important because not only do you have one process, you have two processes. And to have both of them streamlined on the same, I can tell you probably, if I put in percentage basis, maybe 1 out of 5 clients who are trying to buy a house wind up not getting the down payment assistance because the timelines weren't coinciding. Just because they didn't have the timelines, down pat. So and keep in mind, whenever you're getting something free, when they give you something free, do they give it to you when you want it, or they give it to you when they want to give it to you? So what I'm trying to say is when you're getting these free funds, you are not, you're most likely dealing with some type of city, municipality, state, state program, some county program. And these are some type of, city, state worker. They don't work for you. So they're mainly, and I'm not knocking these programs, but they're not going to bend over head over heels just to provide you great customer service. You either fall in line with the process or you don't. Because guess what? There's 10 other people in line trying to get that same exact monies that you're trying to get. So you want to be careful with that.
And understand also these funds are very limited. So it's really first come, first serve. So even if you're first in line, but you don't have all your documents together, you don't have all your ducks in a row, all your T's crossed, your I's dotted, you could very well miss out simply because, again, these funds are a lot of times available for a limited time to a limited amount of people when you have many people applying. So the more you can make sure that you have everything together not wasting time, understanding that this is a serious situation and that you have a lot of people gunning for exactly what you want too. So it's time sensitive and it's a numbers game.
And those for y'all who don't know, the down payment assistance programs that we deal with down here in Miami, in Dade and Broward County, depending on your income. Now keep in mind, when we talk about down payment assistance, this is just not for poverty-stricken families. Right. And that's the other thing that we kind of get. A lot of times people say, well, you know, I make decent money. We have families who make up to $100,000 and still qualify for down payment assistance. Let me just state that one more time. We have families, depending on, you know, family count, size, you know, all that stuff, who make $100,000 as a household and still qualify for down payment assistance. Okay? So, why do I tell you that? Because if you're not actually in front of these people trying to see if you qualify, you probably don't think you don't qualify. And keep in mind, down here they're giving you between $4,000 to $7,000 towards your closing costs. $4,000 to $7,000 towards your closing costs to go to some down payment assistant workshop, to have a few sessions with a counselor. So, for example, I had a lady the other day where I said, you know, you can actually qualify. You should possibly, you know, see if you qualify for down payment assistance. She's like, well, what do I have to do? I'm like, well, you're going to have to go to an 8-hour first-time home buyers workshop on a Saturday. She rolled her eyes. I said, you're going to have to possibly meet with a housing counselor 5 to 6 times over the next, 6 to 7 months, just so they can make sure that they have all your I's dotted and T's crossed. She rolled her eyes. I said, it seems like this is something that you don't want to do. She told me it was an inconvenience. So I asked her, I'm like, ma'am, how much do you make at your job per hour? And she said that she only made $14 an hour on her job. And my question was here it is, you won't spend 8 hours for a first-time home buyers workshop. You won't go see a counselor maybe 30 minutes for 4 to 6 times. That's another 3 hours. So you wouldn't invest 11 hours of your time to make $7,000? Get your tail out my office. No, I'm just playing. I ain't telling that. But what I'm trying to say is, let's not be foolish. Let's not let our pride, or let's not, sometimes you got to do the math. 11 hours. So this lady goes to work for 2 days out the week to make up possibly 11 hours to bring home maybe about $200. But she wouldn't go get down payment assistance for $7,000 because she didn't want to have to exert 11 hours of her time. That's backwards, y'all. Don't fall into that trap.
But that's the reality of what we deal with in our office. Unfortunately, that's the reality of what we deal with a lot. And so it's important for us to come to you guys and let you know, like, that's not the way. Your investment means more to you than that. And at the end of the day, you're not gonna just settle for anything. So don't settle for when it's your future, when it's your time, when it's your money. If all you got to do is sit in a class for 8 hours for $7,000, sign me up 3 times. That's how I feel.
I'm just gonna go sit in class.
I'm telling you,
I'm gonna go sit this Saturday 8-hour class
until I can accumulate down payment.
All right. So we're laughing about it, but it's a serious matter.
It is.
It's a serious matter. And keep in mind, based off of my experience over 20 years of real estate, 20 years of dealing with financing, 20 years of dealing with credit, buying a property is, I would say, probably the biggest vehicle or the biggest avenue for somebody to get their hands on over $50,000 all in one lump sum. The average Joe can't ever get their hands on $50,000 all in one lump sum all at one time. Normally, by being a property owner, accumulating equity over time, you can possibly put yourself in a position where you can get your hands on a lump sum of money, or you can own this property and then get some type of line of credit on that equity and use that money to invest on something that's going to make more money for yourself. All right? So keep in mind, we believe in credit, we don't believe in debt. I want you to have $100,000 worth of credit cards. I don't want you to owe $1 though. All right? Why? Because I want you to set the tone. When I say $100,000, I'm being facetious, but credit is really setting yourself up for the rainy day. So I want you to stockpile your credit. So when you do have an issue, you don't have to go to anybody to go borrow money. You already have the funds there available. You got the fire extinguisher sitting right next to the oven. So when the grease fire comes up, you don't have to go nowhere. How many houses burn down because we don't have a fire extinguisher next to our oven or our stove? Why? Because a simple little grease fire winds up engulfing the whole house. Why? Because we got to wait for the fire department to get there, and they got there in 7 minutes. But the house has $100,000 worth of damage. So the same thing happens from a credit standpoint. A lot of times, if you have a credit card, if you have a line of credit, you can put that fire out immediately. You don't have to, and a lot of times, because we don't have the credit put in place, whatever it is swells even more and more and more and more and more until the last moment where we go borrow the money, where we feel we can't actually, help ourselves out, and now we're paying hand over fist in the interest rate. Why? Because we didn't properly plan ourselves. All right? So just keep that in mind. And our last topic is knowing the different types of loans that are available, which kind of goes into some of the questions that were asked already. All right? Someone before asked about a VA loan. I believe it was Miss Hamilton. All right? So I'm going to give you some of the highlights of a VA loan. VA loan is for a veteran. All right? It goes under the Veteran Affairs. With a VA loan, you have to be a veteran, of course. And that goes under your certificate of eligibility, all right? Depending on your service in the military. And those military members who are veterans, we thank you for all that you've done for our country.
Thank you.
Without you guys, we probably wouldn't have the safe harbor that we do. And I wouldn't be able to do this live video.
Absolutely.
And just feel safe. All right. So we appreciate that. But having a VA loan, if you are a veteran, a VA loan is a very good loan to possibly see if you can qualify for. With that VA loan, it's a little bit different than FHA. VA doesn't require you to put that 3.5% down. All right. So that's a benefit. All right. That you can actually get 100% financing with VA and don't have to go get down payment assistance. Don't have to do all these things. They will finance up to 100% with that particular VA loan. Okay. Another thing with the VA loan, some of the negative aspects with the VA loan. The VA loan is a little bit more paperwork involved. I'm not going to say a lot more paperwork involved. All right. Because you are getting 100% financing, because there are some mortgage insurance, different type of aspects with a VA loan versus a FHA loan, the paperwork is a little bit more stringent. All right, so you need to understand that going in, because you might give yourself a little bit more runway, a little bit more lead time, setting yourself up if you're trying to apply for a VA mortgage. Okay,
Is it the VA mortgage or the is it the VA mortgage where the mortgage insurance is more expensive, or?
Correct. VA has a higher mortgage insurance factoring rate than, let's say, and a mortgage insurance is an insurance. It protects you, but it's an insurance that the lender takes out on you with the anticipation that if you don't pay your mortgage, they have an insurance that will pay the mortgage off for you. So it's like a guarantee that if you go default or go defunct on that particular loan, your lender has an insurance policy put in place that would help kind of cover for you going default. All right. And what does this do? It takes a less risk load off of the lender. But the problem, what it does is it allows them to actually give you that property with 97% financing. But the other aspect of it is now you have to pay the mortgage insurance yourself directly out of pocket. All right. And, that's an upfront fee. So you want to be very careful with that. All right. So mortgage insurance is paid upfront with a FHA loan. Kevin Only asked, what's the difference between an FHA and a VA and a conventional loan? Well, we just kind of explained FHA loan. Conventional loan is going to give you 97% financing. All right. Which is actually less than the FHA. All right. Only by half percent. All right. However, they do allow that other 3% to be gifted to you. All right. They do allow the other 3% to come from a family member, friend, close friend, relative, blah, blah, blah. Okay. However, with conventional insurance, with a conventional mortgage, mortgage PMI insurance is required. Okay, private mortgage insurance. All right, that private mortgage insurance is that insurance that doesn't really, it protects you on the lender's behalf, but yet you won't ever get $1 of that money if you go in default on your loan. It all goes to the lender.
It's a benefit for you, but it protects the lender.
Correct. All right. And that's mainly the difference with a with a Fannie Mae loan. And keep in mind that conventional Fannie Mae loan, the underwriting criteria is going to be more stringent than FHA. It's going to be a more stringent loan than FHA or the first-time home buyers. However, just so you know, under the first-time home buyers program, you can't buy what we call a second home. And I say second home, meaning I live in Miami, I own a house in Miami. However, I travel to Georgia quite frequently, and I buy a second home in Georgia. They won't qualify a second home or an investment property. An investment property is, hey, I own my property, or I don't even own the property, but I'm buying, let's say, a duplex, or I'm buying a single-family house. I don't want to live in it. I want to rent it out. FHA will not finance me for buying a house and renting it out. They only finance a house for me to own or occupy it, which means I have to live in it. Okay? And keep in mind, if you are buying a house for investment purposes, your down payment is going to be significantly higher. If you're buying an investment property, they're going to want anywhere between 20 to 30% down per se. Why? It's because that's not the roof over your particular head. And they know if you go in financial distress, that's probably going to be one of the first things you stop paying because it doesn't directly affect your lifestyle. It affects your tenant's lifestyle. So by history and trends, they have noticed that, hey, you know what? The individuals who we've given an investment loan for, if they got in financial distress, the first thing they stopped paying for was the investment property. You know why? Because a lot of times they're collecting rent on it. So they're collecting the rent, they're living off the rent, but they're not using that rent to pay off the mortgage payment. All right? So it winds up being a budgeting issue when it's all said and done. All right? Any more questions, any more concerns? We're getting ready to wrap up. We're just giving you guys the 10 top things to do to purchase a house as a first-time home buyer. We hope that we gave you some useful information. If you do have any last questions, please post them so we can answer them. We're getting ready to wrap up, and we appreciate you hanging out with us. Tag 5 people who want to buy a house. Don't be selfish.
Don't be selfish. Come on now.
Spread the love. We spread the love. We are taking our time every Wednesday, every other Wednesday to give this and pour this back into you guys. To be honest, do we really get anything from it? I don't know. I could be losing clients from it. Why? Because I'm giving all the information right here.
I know I got some emails. Trevor, where you at? Why you ain't answering my emails, my calls?
All right. So we do this for y'all. All right. We care about you. We are we're at a community-based credit repair company.
And let me say this: you may not believe what Andre just said, but believe it or not, credit repair is one of those fields where you find some of the biggest misconceptions and unfactual, myths. So us coming on live really is us really wanting to spread the word about credit repair in a good way. That as far as the repairing of your credit or even just getting knowledge about credit, that we're part of the solution, that we're part of the people that are out there that are spreading the good word, making sure people like you are getting that positive help or the right help that you need. So this truly is about love, loving our clients, loving our community, loving the people that follow us and want to know this information. So this is truly why we're doing it. Not to sell, as you guys see, I don't think one video have we even ever talked about Credit 360 as a business, what we do, how much it costs, enrolling the program. This is us really wanting to spread the word, the positive word about credit, the do's and don'ts, the factual side of it, making sure that you guys are always on the up and up, and everybody, all of us around here walking around with excellent credit scores. So please keep tuning in. When are we scheduled again?
Not this Wednesday, not next Wednesday, but the following Wednesday,
20th?
which is the 20th. Yes, it will be June 20th. Y'all, please, follow us. Share this video, even though it's over with. Please share it. We're asking you. It can help somebody. The more that we become more financially secure as a whole, the more everybody is going to actually benefit from this. Okay. So don't get me wrong. Poverty affects everybody. All right.
Absolutely.
Struggle affects everybody. All right. So we can kind of get out there and we can kind of just just help each other some type of way. We'll be all right. We'll be all right.
And all it takes is a simple sharing of this post. And just keep tuning in. Please keep tuning in. Leave us your comments even after the video. If you have some good comments, if you catch this later on and you still have some questions or some comments that you want to leave for us or ask us, please feel free to do so. You can drop us a message in inbox. You can reach us directly. You can give us a call here at the office. Should we leave the number? Yeah, 305-235-4848. You can hit us on the web, www.credit360.biz, and keep tuning in, man. We love y'all.
All right. We have an open phone policy. We're here for you guys. Any questions or concerns, please feel free to call. Ask my staff. Test my staff out, please. Let me see what they know. All right. Who tells you to call them and ask questions? All right.
That's a good point. That is a good point.
Guess what? Every time you call and ask them a question, it takes money out of our pocket. But we'd rather you call and ask that question and have useful, great information than to go out there and kind of make some of the mistakes that we see happening every day, not utilizing yourself from a financial and credit standpoint.
It's still about each one, teach one. So if you call this office, if you have a great question about credit, we're more than happy to give you the right answer so you can spread the right word about credit.
All right. Once again, tag this, share this, please. I'm watching. I'm seeing who's sharing. I'm watching the shares. And if you're a client of Credit 360, please tag, please share this. We will be monitoring, and we will also possibly give you some credits towards your deletions just for getting this word out there. All right. Peace. Appreciate it. Love y'all.